into the often bewildering, sometimes thrilling, and always vital world of financial markets.
It certainly can be bewildering.
Yeah, if you've ever felt overwhelmed by, the sheer volume of conflicting advice, the flashy promises from gurus, or just the relentless buzz of market noise, you are definitely not alone.
It's a common feeling.
You want to be well-informed, right, to make smart decisions with your money, but honestly, where on earth do you even begin? It can feel like trying to navigate a dense jungle without a map.
It absolutely can feel that way. And that's precisely why our guide today is not just critical, but truly foundational.
Right.
We're talking about Benjamin Graham's The Intelligent Investor.
Ah, the classic.
Exactly. This isn't merely a book. It's a masterpiece. It genuinely alters how we view the world of money, and it consistently renews itself by educating generation after generation of investors.
What's truly astonishing, to me anyway, is how prophetic this work remains. Graham wrote this decades ago, right? After experiencing the tumult of early 20th century markets, the Great Depression.
Yeah, he saw it all.
Yet it reads more prophetically than ever today, especially when you consider, say, the wild bull market of the late 1990s and the brutal bear market that followed in the early 2000s. It's like he had a crystal ball.
He certainly had a profound understanding of human nature and market psychology. And that, unlike technology or specific companies, remains remarkably constant, doesn't it?
It really does.
It's truly a foundational text for anyone serious about understanding how to approach the markets with wisdom and discipline.
So what's our mission for you, our listener, today?
Well, consider this deep dive a shortcut, maybe, a direct route through that dense financial jungle we mentioned, a guided path.
We're extracting the essential nuggets of knowledge and insight from Graham's timeless work, and also some modern commentary that really validates his principles. The goal is to equip you with the emotional framework and the analytical tools essential to financial success.
Essentially, we want to help transform you into a vastly more intelligent investor by the end of our conversation.
That's the aim. We'll unpack the core distinction between true investment and dangerous speculation, a line Wall Street often seems keen to blur.
Very keen. We'll explore how to deal with the market's often irrational mood swings, introduce you to Graham's famous Mr. Market.
Yes, Mr. Market.
And examine practical strategies for both defensive and enterprising investors. Crucially, we'll also uncover common pitfalls you absolutely need to avoid, all through the lens of Graham's enduring wisdom.
Okay, let's unpack this then. Our journey begins with what Graham himself considered the bedrock principle, the absolute starting point for anyone who wants to build wealth responsibly. The crucial distinction between true investment and dangerous speculation. This isn't just about semantics, is it?
Oh, absolutely not. It's the very foundation upon which all sound financial decision-making rests. Graham's definition of an investment is incredibly precise, and it acts as a bright line, not some kind of blurry suggestion.
Okay, so what is that definition exactly?
He states it's an operation that, and I'm quoting him directly here, on thorough analysis, offers safety of principle and a satisfactory return.
Thorough analysis, safety of principle, satisfactory return. Got it.
Right. What he means is that before you put your money in, you've done your homework. You understand what you're buying, you genuinely expect your initial capital to be safe, and you anticipate a reasonable profit.
Okay, that sounds sensible.
Here's the critical part, though. If an operation doesn't meet all of these criteria, if the analysis isn't thorough, if the principal isn't reasonably safe, or if the return isn't satisfactory, it is, by his definition, not an investment. It is speculation. Full stop.
And speculation, for many, can be incredibly alluring, maybe even intoxicating, right? It's always fascinating, and it can be a lot of fun while you're ahead of the game, like hitting a big jackpot at a casino. That initial thrill can be hard to resist.
Precisely. But here's Graham's stark warning. On Wall Street, much like a casino, the odds are fundamentally calibrated for the house. The brokers, the financial institutions, the market makers, to prevail against speculators in the long run.
So the house usually wins.
Usually, people who speculate more often than not end up making money for their brokers, not for themselves. Investing, by contrast, Graham describes as a unique kind of casino. It's one where you cannot lose in the end so long as you play only by the rules that put the odds squarely in your favor.
That's a powerful distinction.
It is. This distinction is critically important, yet Wall Street perennially downplays the durable virtues of investing while relentlessly hyping the gaudy short-term appeal of speculation. They want you trading, not necessarily investing for the long haul.
That really drives home the point about the inherent conflict of interest there. And we've seen this play out over and over again throughout history, haven't we? Graham himself lived through intense market manias, long before the internet or even widespread personal computers.
He did indeed. Think about the Savold tire story from 1919. Graham himself was a young man then, a rising star on Wall Street, and he witnessed firsthand this new offering in the booming automotive business. The excitement was palpable.
A hot new stock and a hot new industry.
Exactly. Savold tire stock earned a shocking 250% return on its very first day of trading. People were ecstatic, convinced they were witnessing the dawn of a new era. Investors, or rather speculators, piled in, chasing those immediate gains.
Good.
But by October of that same year, just months later, the company was exposed as a complete fraud. The stock became worthless.
Wow, 250% gain to zero in months.
Yeah. Graham, reflecting on such events, noted that the madness of the internet boom and bust decades later would not have surprised him in the slightest. The names change, the technology changes, but human nature and the temptations of quick riches remain constant.
That's a perfect historical echo. The late 1990s and early 2000s internet bubble truly showed us that. We saw this phrase, reckless investors, used by the media and even financial professionals, which Graham would have called a laughable contradiction in terms. He famously compared it to spendthrift misers. It's just not possible, right? You simply can't be a reckless investor.
If you're reckless, you're by definition a speculator, or maybe if you're just a gambler, not an investor in Graham's view.
Right.
And the numbers from that .com era are truly sobering. They paint a stark picture of the consequences of blurring that line between investment and speculation. Consider the Monument Internet Fund. A $10,000 investment made in May 1999 would have shrunk to roughly $2,000 by year-end 2002.
Ouch! An 80% loss.
Imagine watching 80% of your capital simply evaporate. Similarly, a $10,000 investment in Villar's fund at the end of 1999 could have left you with just $1,195 by the end of 2002.
Almost 90% gone.
This wasn't just a correction, it was a massive, widespread destruction of wealth for those who were speculating. Even well-known media personalities like Jim Cramer, whose stock picks were touted as winners, saw devastating results. A hypothetical $10,000 investment spread equally across his favorites would have lost 94%, leaving a grand total of $597.44 by year-end 2002.
Less than $600 left from 10 grand. These weren't small losses, they were near total wipeouts. It's incredible how quickly that can happen when people lose sight of value and get caught up in the frenzy.
Absolutely, and the hype from Wall Street analysts certainly fueled a lot of that irrational exuberance.
You had analysts like Henry Blodgett, who in 1998, with Amazon.com trading at $150, made the astonishing forecast that it would shoot to $400. The stock gained 19% just that day.
Yeah, I remember that.
And despite Blodgett's one-year forecast, it actually soared past $400 in just 3 weeks. Or Walter Piesik, who in December 1999, with Qualcomm already up like 1,842% that year.
An insane run-up already.
Predicted it would hit $1,000 a share. The stock soared another 31% that very day. These kinds of calls create self-fulfilling prophecies, at least for a while, pulling in even more unwary speculators.
What's fascinating here, and what Graham constantly emphasized, is that obvious prospects for physical growth in a business do not automatically translate into obvious profits for investors. This is often a cruel paradox.
No, so?
Because our human intuition tells us to chase what's clearly growing, what's new and exciting. We confuse a great story with a great investment, but by the time a company's prospects are obvious, by the time everyone expects the same thing, that an industry is obviously the best and its future is endlessly bright, that perceived value is already reflected in the stock price, and usually then some.
So the good news is already priced in.
Exactly. There's no inherent edge left for the individual investor. In fact, the edge has probably swung to the other side. You're simply paying a premium for what everyone already knows or thinks they know.
So the key takeaway from this first principle is crystal clear. Wall Street perennially downplays the durable, often, let's face it, boring virtues of true investing.
Boring but effective.
And relentlessly hypes the gaudy, exciting appeal of speculation. The distinction between investment and speculation has always been a useful one, and its disappearance from public discourse is a cause for real concern, especially for your financial health.
It really is. It's about protecting yourself from that inherent conflict of interest that benefits brokers and institutional traders, not necessarily you.
Okay, so we've nailed down that crucial distinction. Moving on from that fundamental point, let's delve into one of Graham's most famous and perhaps most enduring allegories. Mr. Market.
Ah, yes, Mr. Market. A brilliant concept.
It really is. This parable is central to understanding and hopefully taming the market's often erratic and frankly quite human mood swings. Expert, for those unfamiliar with him, could you introduce this hypothetical business partner of ours and explain the core lesson he embodies?
Of course. Graham asks you to imagine you own shares in a private business and you have a partner named Mr. Market. Every single day, without fail, Mr. Market shows up at your door.
Every single day. That sounds tiring.
It would be. He shows up offering to either buy your shares from you or sell you his shares. But here's the twist, and this is where his character truly emerges. His prices are wildly fluctuating. Some days he's incredibly enthusiastic, maybe even euphoric, about the future of your business. He'll quote ridiculously high prices, practically begging you to buy or sell at inflated values. On other days, though, he's gripped by fear and despair. He's convinced the business is doomed, and he's desperate to sell at incredibly low, even laughable prices.
So he's bipolar, essentially.
You could say that. He's driven entirely by emotion, not by rational analysis of the business's value.
So the intelligent investor's job is not to trade with Mr. Market just because he constantly begs you to. He sounds like that annoying friend who calls you every day with a new urgent scheme.
Exactly. That's the perfect analogy. Your job is not to react to his mood swings. Instead, you should only do business with him, but only to the extent that it serves your interests.
So turn his moods to your advantage.
Precisely. This means that when his price is irrationally low, driven by his despair, that's when you might consider buying from him. And when he's ridiculously high, driven by his euphoria, that's when you might consider selling to him. The rest of the time,
Ignore him.
you simply ignore him. Focus on the underlying business, and remember that his erratic behavior is his problem, not yours. You wouldn't let a manic depressive business partner dictate your every move in a private company, so why let Mr. Market do it with your publicly traded shares?
That brings us squarely into the realm of emotional discipline, doesn't it? Which is arguably one of the hardest parts of investing. It's not about having the highest IQ, it's about having the right character traits, like patience and fortitude.
Indeed. The pioneering psychologists Daniel Kahneman and Amos Tversky, for instance, their research showed that the pain of financial loss is more than twice as intense as the pleasure of an equivalent gain.
Twice as intense! Wow!
Think about that for a moment. Making $1,000 feels good, certainly. But losing $1,000 creates an emotional wallop, a gut punch, that's literally twice as powerful psychologically.
That explains a lot about market panic.
It does. This fundamental human wiring helps explain why losing money is so incredibly painful that many people, terrified at the prospect of any further loss, panic and sell out near the bottom, or become so paralyzed they refuse to buy more even when prices are incredibly attractive when Mr. Market is having one of his depressive episodes.
It's a classic fight or flight response, isn't it? Our brains are literally wired for it. When financial loss hits, it doesn't just register as a number on a screen, it fires up your amygdala, that ancient part of the brain that processes fear and anxiety.
You can't help but feel it viscerally. It's primal.
So if our amygdala is firing, how does Graham suggest we override that primal urge to panic sell or chase euphoria? Are there practical mental exercises he recommends beyond just sort of ignoring Mr. Market?
He essentially recommends a detached analytical approach. And a key part of that is learning to put losses in proportion. Perspective is key.
Okay, how does that work?
A common example is when a TV reporter shouts, "The market is plunging, the Dow is down 100 points." Most people instinctively shudder. They feel the raw magnitude of that 100 points.
Yeah, sounds bad.
But if the Dow's level of, say, 8,000, that's just a 1.2% drop. It's comparable to a trivial temperature change, like the weather forecast shrieking about the temperature dropping from 81 degrees Fahrenheit to 80 degrees. You wouldn't panic about that, would you?
No, of course not. That's a fantastic analogy.
When you forget to view changing market prices in percentage terms rather than absolute points, it's all too easy to panic over what are, in reality, minor vibrations. Graham's point is to focus on the long-term value of the business, not the daily ticker noise.
It really puts it into perspective and helps reframe those scary headlines. This emotional roller coaster also leads to another common trap, trying to forecast the market's next move. Everyone wants to know where it's going, don't they? The Holy Grail.
Absolutely. And Graham was absolutely convinced that the average investor cannot deal successfully with price movements by endeavoring to forecast them. It's a fool's errand for most people.
Even the experts struggle, right?
Massively. He pointed to examples like Alan Greenspan, who in 1973, as the Federal Reserve Chairman no less, was unqualifiedly bullish on stocks.
Yeah.
just before a catastrophic bear market where U.S. stocks lost 37% of their value.
If the head of the Fed can't get it right.
Exactly. What hope does the average individual have trying to time the market based on headlines or gut feelings?
And we've seen this pattern repeat with market strategists and media darlings in more recent times, too. In the late 1990s, analysts like Ralph Acampora and Abby Joseph Cohen consistently missed the mark, often spectacularly.
Oh yes, those names bring back memories.
Acampora predicted NASDAQ would hit 6,000 on the very day it hit its all-time high of 5048.62, just weeks before it shriveled down to 3321.29.
Talk about bad timing.
And Abby Joseph Cohen, a widely quoted strategist at Goldman Sachs in March 2001, predicted the S&P 500 would close the year at 1,650 and the Dow at 13,000, stating they didn't expect a recession, even as the economy was visibly sinking into one.
And how did that turn out?
Her forecasts ended up being off by 30% and 23% respectively. These weren't minor misses, they were huge errors.
This highlights what Graham called the paradox of success in the market. Any approach to money-making in the stock market, which can be easily described and followed by a lot of people, is by its very terms too simple and too easy to last.
Meaning if everyone knows the trick, it stops working.
Exactly. The market adapts, what works for a time becomes common knowledge, gets overused, the inefficiency gets arbitraged away, and then the edge disappears. If everyone is doing it, it stops working. This is why following hot tips or popular strategies is almost always a losing game in the long run.
So the key takeaway here is actually profoundly liberating, isn't it? Especially if you have a long investment horizon, say, at least 25 or 30 years.
It is. There is really only one sensible approach for most people in that situation. Buy every month, automatically, and maybe whenever else you can spare some money. Just keep buying methodically.
Ignore the forecasts, ignore the noise.
Pretty much. Graham even mused that an intelligent investor would actually be better off if his stocks had no market quotation at all, for he would then be spared the mental anguish caused him by other person's mistakes of judgment.
Imagine not seeing a price. You'd be forced to focus purely on the business itself.
Which is exactly where your focus should be. This leads us naturally into charting your course, or rather, the practical strategies Graham outlines for investors once they've got the mindset right.
Okay, let's get practical.
He makes a very clear distinction. There are two paths, the defensive or passive investor, and the enterprising or aggressive investor. And he firmly states there is no room in this philosophy for a middle ground.
No dabbling. Pick a lane.
Pick a lane. And for the vast majority of people, he strongly recommends the defensive path. Why? Because it demands less time, less specialized expertise, and frankly, less emotional energy.
I think that's a crucial point that most people overlook. They often try to dabble in the middle ground, trying to time the market a little bit, picking a few hot stocks, maybe some crypto.
Yeah, mixing strategies without a clear plan.
And ultimately making things much harder and probably riskier for themselves. So let's start with the Defensive Investors Program. What does that look like in practice?
The Defensive Investors Program emphasizes balance and allocation. That's a truly core principle for long-term stability. Graham recommends dividing your funds between high-grade bonds and high-grade common stocks, typically starting with a 50-50 split.
50-50 stocks and bonds. Seems simple enough.
It is, but the crucial rule he lays out is that you should never have less than 25% or more than 75% of your funds in common stocks, with a consequent inverse range for bonds. So you might shift between 25-75 and 75-25 depending on market conditions or your risk tolerance, but you stay within those bands.
Okay, so there's some flexibility, but within strict limits.
Exactly. This structured, balanced approach helps manage risk by ensuring you're not overly exposed to one asset class and enforces discipline. It prevents you from chasing market highs with 100% stocks or panicking during lows and going all to cash. It's about maintaining a stable ship in often choppy waters.
And within that stock allocation, there's a powerful and deceptively simple technique called dollar cost averaging. Can you explain that?
Yes, this is a core strategy for the defensive investor, specifically designed to automate discipline and remove emotion from the buying process. Dollar cost averaging means investing the exact same number of dollars in common stocks each month or each quarter, regardless of what the market is doing.
So just keep putting the same amount in, rain or shine.
Rain or shine. The beauty of this simple act is that when prices are low, your fixed dollar amount buys more shares. When prices are high, it automatically buys fewer shares. Over time, this results in a satisfactory overall average price for your holdings, significantly reducing the risk of buying everything at a market peak.
It takes the guesswork out of timing.
Completely. It removes the emotional decision-making from market timing because you're simply executing a predetermined plan.
So what's the ideal, most practical way for an individual listener to implement dollar cost averaging today, given all the options out there like ETFs and mutual funds?
The ideal way, definitely in line with Graham's philosophy of simplicity and risk reduction for the defensive investor, is to dollar cost average into a portfolio of low-cost index funds.
Index funds, owning the whole market, basically.
Pretty much. These funds, by their very nature, own a broad basket of stocks or bonds, often representing an entire market like the S&P 500 or even the total U.S. stock market. This approach means you renounce not only the impossible guessing game of where the market is going, but also the equally challenging task of trying to pick which specific sectors of the market, tech, healthcare, energy, whatever, and which particular stocks or bonds within them will perform best.
You're admitting you don't know and you don't need to know.
Exactly. Low-cost mutual funds, or ETFs, tracking broad market indexes like the S&P 500 or the Wilshire 5000 are perfect for this strategy. They provide immediate, wide diversification at very low cost.
And diversification is key to this, right? It sounds like it minimizes your odds of being wrong while maximizing your chances of being right, just by owning everything.
Exactly. Graham understood that over long periods, only a handful of stocks turn into the super stocks that go up 10,000% or more. The vast majority don't. Consider the 30 best performing stocks over the 30 years ending in 2002.
Okay, who is on the list?
You might expect tech giants, right? But guess what? The list included unexpected names you'd probably never guess, like Southwest Airlines, Worthington Steel, Dollar General, and even a snuff tobacco maker named UST Inc.
Wow. Not exactly the glamorous names.
Not at all. The point is, it's nearly impossible for anyone, even professional investors with huge research teams, to pick these winners consistently in advance. This underscores the profound power of broad diversification through something like an index fund. You don't need to pick the winners, you just need to own the market and let the winners inevitably emerge within your portfolio. It's a humbling but incredibly effective strategy.
Okay, but what if a defensive investor still feels compelled to pick individual stocks? Maybe they just can't resist trying. Are there any specific guidelines Graham gives for identifying quality companies beyond just hoping they'll grow?
He does provide very clear criteria for individual stock selection, even for the defensive investor who wants to dabble a bit beyond index funds, though he'd probably advise against it for most. First, he emphasizes adequate size. Look for large, prominent, and conservatively financed corporations, big, stable companies. For industrial companies, he suggests their common stock at book value should represent at least half of the total capitalization, including any bank debt. This ensures the company isn't overloaded with debt relative to its equity.
So financially strong.
Right. Second, a strong financial condition, which is really covered by that conservatively financed aspect. Third, a long-term dividend record. The company should have paid continuous dividends for a considerable number of years, maybe 20 years or more. This demonstrates consistent profitability and a shareholder-friendly approach.
Dividends matter.
To Graham, yes. And finally, stable earnings, meaning you should limit purchases to stocks with a moderate PE ratio that's price to earnings. He suggests no more than 15 times average earnings over the past 3 years.
So don't overpay for earnings.
Exactly. And he explicitly warns against using forward PE ratios based on Wall Street's guesses about unknown future earnings. Those forecasts are notoriously unreliable. You want to pay a reasonable price for demonstrated earnings, not hoped-for earnings.
That makes sense. What about the bond component of the portfolio? How should a defensive investor approach that side of the equation? Bonds seem complicated too sometimes.
For bonds, the choice often involves taxable versus tax-free bonds, mainly a matter of arithmetic based on your current tax bracket. For example, back in 1972, you might choose between a 7.5% yield on high-grade corporate bonds or a 5.3% yield on prime tax-free municipal bonds, which was better dependent entirely on whether your maximum tax bracket made the tax-free option more appealing after tax.
So you need to do the math based on your own tax situation.
Correct. Graham also highlights Treasury inflation-protected securities, or TIPS, as potentially an ideal substitute for the proportion of your retirement funds you would otherwise keep in cash or very short-term bonds.
TIPS. Okay, how do they work?
They're designed to protect your principal against inflation. The principal value adjusts with inflation, so the interest payments, while usually low, rise with inflation too. They offer an intelligent way to keep a portion of your money absolutely safe and entirely beyond the reach of the long, invisible claws of inflation, which can silently erode purchasing power over time.
Good for the super safe part of the portfolio.
Exactly. However, it's worth noting they're generally best suited for tax-deferred accounts like IRAs or 401k. Due to their unique tax characteristics, the inflation adjustment is taxed annually, even though you don't receive it in cash until maturity.
Got it. So that's the defensive approach. Disciplined, diversified, built for the long haul, largely automated through things like index funds and dollar cost averaging. Simple, but not necessarily easy because of the discipline required.
Precisely. But for those few with considerable time, specialized expertise, and a genuine inclination to treat investing as a serious business pursuit, there's the enterprising investor path.
The road less traveled, perhaps?
Definitely. And Graham emphasizes this path is not for the faint of heart, nor for those seeking easy, aggressive growth thrills. It requires significant effort and a considerable knowledge of security values. An enterprising investor views investing as a business enterprise, putting in extra time and effort, like running a business.
It's crucial to clarify, an enterprising investor is not one who just takes more risk than average or who buys super speculative, aggressive growth stocks, right? It sounds like it's about more work, not necessarily more risk in the conventional sense.
Absolutely not about just taking more risk. It's about doing the diligent, often unglamorous work to find true underlying value that the market, in its short-sightedness or temporary pessimism, has overlooked.
So if you're going to be enterprising, you're not trying to be a daredevil. You're trying to be a deep dive researcher, a financial detective, if you will. What exactly are they looking for? Where do they hunt for these opportunities?
They're seeking bargains. Plain and simple. This means following policies that are both inherently sound and promising, but crucially, not popular on Wall Street at the moment. They look for common stocks that are undervalued because of a lack of interest or perhaps an unjustified popular prejudice.
So, swimming against the tide.
Very much so. Yeah. This could involve looking at low multiplier stocks, those selling at the lowest price to earnings multiples relative to their demonstrated earnings power. While one experiment Graham mentioned from the late 60s, 70s yielded poor results for this specific method, broader historical patterns suggest that such out-of-favor companies often represent opportunities for the diligent investor prepared to wait.
And there's that fascinating, almost unbelievable type of bargain that Graham highlights. Companies selling below their working capital value. That sounds like a true steal, like finding money on the street.
It absolutely is, and perhaps the most readily identified type of bargain he describes, though less common today than in his time. It means a common stock that sells for less than the company's net working capital alone after deducting all prior obligations like debt and preferred stock.
Remind us what net working capital is again?
It's essentially current assets, things like cash, inventory, accounts receivable, minus all current liabilities. So if a company has, say, $10 per share net working capital, cash and stuff easily convertible to cash minus short-term debts, but its stock is trading at $7.
You're getting the operating assets for less than they're worth.
And you are essentially paying nothing at all for the company's fixed assets like buildings, machinery, land, patents, brand names. You're getting all of that for free. A 1957 compilation, even when the market wasn't particularly low, found about 150 such common stocks. It indicates these opportunities pop up, though they certainly require digging and careful analysis of why they are so cheap.
He also mentions companies suffering from temporary neglect or unpopularity. That sounds like a less obvious but still potentially rich hunting ground for the enterprising type.
Indeed. These are often solid businesses going through a rough patch or just temporarily out of fashion. A classic example he used was National Presto Industries. In 1968, it sold for $45, which was 8 times earnings. But by 1970, despite its per-share profits actually increasing significantly, the stock price declined to 21.
Profits up, price down. How does that happen?
It was selling at less than 4 times its record earnings and even below its net current asset value. It was simply out of favor with the market mood at the time. Another type of situation is the market's failure to recognize true earnings power, perhaps due to complex accounting. Like Northern Pacific Railway in 1946-47. Its stock dropped from 36 to 13.5 despite earning $10 per share.
Why the disconnect?
Its true earnings power was simply concealed by accounting methods peculiar to railroads at the time. An enterprising investor would need to dig into those financials, understand the accounting, and see the hidden value others were missing.
That definitely sounds like hard work. What about special situations? That sounds even more complex, like something only a true, highly specialized expert could handle. Is that really for individuals?
You're absolutely right to be cautious there. Graham describes these as a technical branch of investment, and they're generally not for the average individual investor, even an enterprising one.
What do they include?
They include things like intersecurity arbitrages, exploiting tiny temporary pref differences between related securities participating in announced mergers, or investing in companies undergoing liquidation, where the breakup value is expected to be higher than the current market price.
Sounds risky.
It can be. Well, the number of such deals increased greatly in the late 1960s. Competition and the risk of deals falling through often diminished their profitability. Graham specifically warns that this is wholly inappropriate for most individual investors, unless they can dedicate a significant amount of capital, say at least $100,000 in his time, much more today, specifically to distressed securities alone. That's necessary for proper diversification in this highly specialized and risky area. It's really expert-level stuff.
Okay, so for most enterprising investors, it's about deep analysis of regular businesses and finding value, not these super complex plays. What specific metrics would an enterprising investor focus on for analyzing businesses, maybe beyond just PE ratios or net working capital?
A key metric, one that Warren Buffett, Graham's most famous student, later expanded upon with his concept of owner earnings, is return on invested capital, or ROIC.
ROIC, what does that tell you?
Think of it as how efficiently a company generates profits from the total capital, both debt and equity, that it has put into its business over the years. It helps you see how much bang for the buck the company is getting from its operations. Is it generating good returns on the money it employs?
What's a good ROIC?
An ROIC of at least 10% is generally considered attractive, but Graham noted even 6% or 7% could be tempting if the company has strong, durable competitive advantages, like strong brand names, or if it's under a temporary cloud that seems likely to pass eventually. It's a powerful indicator of underlying business quality and management effectiveness.
And speaking of management, how does an enterprising investor know if the management team is trustworthy and truly acting in the shareholders' best interests? That seems crucial, but hard to judge from the outside.
It is crucial and requires judgment. A critical eye towards management is absolutely essential. Graham emphasized looking for managers who truly think like owners, not just managers acting as hired hands.
How can you tell?
He suggests two simple yet profound tests for detecting potential issues. First, are the company's financial statements transparent and straightforward? Or are they opaque, riddled with complex footnotes, jargon, and confusing terminology designed to obscure rather than clarify? Opaque statements are a huge red flag.
If you can't understand it, stay away.
Pretty much.
Okay.
Second, do non-recurring charges actually keep recurring year after year? If a company constantly reports one-time or special costs that somehow appear every quarter or every year, that's a clear sign that management may not be prioritizing long-term shareholder interests and might be trying to mask ongoing operational issues by constantly adjusting the reported numbers.
Okay, those are good practical tests. It's clear that both the defensive and enterprising paths demand significant discipline, just applied in different ways. Now let's talk about some of the biggest pitfalls investors fall into, particularly when it comes to navigating the vast, often misleading information landscape out there. First up, the illusion perhaps, of growth stocks. Everyone wants to find the next big thing, the company that will grow to the moon, right?
Precisely. It's the siren song of the market.
Yeah.
But Graham points out a really troublesome paradox here. Mathematical valuations, complex models projecting future cash flows, have become most prevalent precisely in those areas where one might consider them least reliable. Meaning the more a valuation depends on uncertain anticipations of the distant future, on what a company might do years or decades from now, and the less it is tied to demonstrated past performance and current assets, the more vulnerable it becomes to massive miscalculation and serious error. You're not valuing a tangible business as much as you're valuing a dream, and those are notoriously hard to quantify accurately.
This leads to what's sometimes called the infinite value fallacy, or maybe the no price is too high fallacy, doesn't it? If a company could truly grow at a very high rate, say 8% or more, indefinitely into the future, its theoretical value using some models would actually be infinite.
Right, which implies that no price would be too high to pay for the shares today.
That sounds utterly absurd when you say it like that.
Which of course it is in the real world. No company grows that fast forever. This highlights the inherent speculation involved in pricing high-growth stocks based on very long-term projections. You're making enormous assumptions about an unknowable future. And history is littered with examples of highly touted growth stocks crashing hard when those rosy assumptions proved faulty.
Can you give some examples?
Sure. International Business Machines, IBM. Once considered the absolute best of common stocks, the bluest of blue chips, lost 50% of its market price in 6-month declines in both 1961-62 and again in 1969-70. Texas Instruments, another tech darling of its era, rose incredibly from 5 to 256 without ever paying a dividend.
Wow, huge run-up.
But later saw its earnings drop by nearly 50% and its price collapse by 4/5, plummeting all the way down to 49.
Ouch.
And more recently, think about the dot-com aftermath. Microsoft, a phenomenal company, still dropped 55.7% from 2000 through 2002. Cisco, another market leader, lost a staggering 76% of its value in the same period.
So even great companies can be terrible investments if you pay too much.
Exactly. As Graham Riley noted, the hotter they are, the harder they fall. What seems like common sense to a speculator chase, the highest growth, is often the direct path to ruin for a true investor focused on value and margin of safety.
That's a powerful reminder that history often rhymes, even if it doesn't exactly repeat. Beyond just chasing growth stocks at any price, investors also need to be incredibly wary of accounting shenanigans. How do companies try to mislead us through their books, and what red flags should we be looking for?
Oh, there are several subtle but significant red flags to watch out for. One is the recurring non-recurring charge we touched on earlier. This is a classic. Take Micron Technology, for example. In 2001-2002, they repeatedly booked inventory write-downs, which were presented as special charges or non-recurring costs, implying they wouldn't happen again.
But they did.
But they did. They booked further write-downs in every one of the next 6 fiscal quarters. Such practices impair the true comparability of the numbers year to year and can mask underlying operational issues that are, in fact, quite recurring. It's like saying you have a non-recurring flat tire every time you drive over a nail you didn't see.
That's a great analogy. What about more egregious examples, the kind that lead to outright financial scandals like Enron or WorldCom?
One particularly problematic tactic, which was central to scandals like WorldCom, is the improper capitalization of operating expenses. Companies like Global Crossing and Quest were also notorious for this. They improperly booked normal operating expenses, things like salaries, marketing, or even routine line maintenance costs, onto their balance sheet as capital assets, rather than recognizing them immediately as expenses on their income statement.
Why would they do that?
It makes a said company appear to be growing and healthy because its current reported profits look inflated. But its underlying businesses aren't actually generating enough cash to cover their real ongoing costs. It led to massive losses for investors who bought into the illusion created by this accounting trick.
So watch out for expenses being treated as assets. Any other red flags?
Yes. Be wary of companies that heavily emphasize pro forma earnings, which often exclude costs that management conveniently wants you to ignore, like stock option expenses or restructuring charges. Also, excessive use of acronyms like EBITDA, earnings before interest, taxes, depreciation, and amortization, instead of focusing on true net income. EBITDA can paint a rosier picture because it ignores real costs like depreciation, taxes, and interest. And finally, watch out for fat infusions of other people's money, debt, or equity issuance labeled as cash from financing activities on the cash flow statement, especially if the company isn't generating sufficient cash from its core operations to fund itself. It can mask underlying business weakness.
These are such subtle traps, requiring a really keen eye on the financial statements. What about more overt corporate actions like stock splits? They always seem to get investors excited, and the stock price tends to jump after one is announced. Is there any real value there?
Stock splits are a classic example of corporate actions that often play into the worst instincts of the investing public, rather than providing any real benefit to true investors. Graham completely debunks the myth that splits make you richer. He says it's exactly like getting 2 nickels for 1 dime.
You have more pieces of paper, but the pie itself hasn't grown.
Exactly. You own the same percentage of the same company. Yet companies like Exodus Communications back in 1999, which was actually losing money hand over fist, frequently use splits specifically to hype and promote their stock, to make it seem cheaper or more accessible. Just the news of a 2-for-1 split could drive a stock up 20% or more in that environment, even though it had zero real impact on the underlying business value.
So managers who do that are just playing psychological games.
Pretty much. In Graham's view, managers who use splits this way are, in his words, treating their investors like dolts, playing on their psychological desire for more shares or a lower price per share, rather than focusing on building real business value.
That's a great way to put it. And what about dividends versus stock buybacks? In modern markets, buybacks seem to be much more in vogue. maybe because they can boost earnings per share. But Graham had a strong opinion on dividends, didn't he?
He certainly did. Graham firmly believed the burden of proof is on the company to show that you, the shareholder, are better off if it does not pay a dividend. He saw dividends as a crucial discipline for management.
How so?
It forces them to distribute real earnings back to the owners, rather than hoarding cash, potentially squandering it on unwise acquisitions, or investing it poorly in low-return projects within the company. While stock buybacks can return capital to shareholders and can be beneficial if the stock is undervalued, Graham was wary that they could sometimes be influenced by executive stock options.
How do options play into it?
Dividends tend to dampen a stock's price volatility slightly, which actually reduces the theoretical value of executive stock options, which benefit more from volatility. This might make buybacks, which don't have that dampening effect and can boost EPS, more appealing to management who hold lots of those options.
Interesting conflict there.
Yeah. Companies like Oracle and Microsoft for many years accumulated mountains of cash instead of paying significant dividends. Graham would argue this proved that while their operations might be highly efficient at generating cash, their capital allocation decisions was no longer efficient. In Microsoft's case, by year-end 2002, its cash balance had swollen to an astonishing $43.4 billion. Clear proof the company could find no good use for the cash its businesses were generating, yet it wasn't returning much of it directly to shareholders via dividends at that time.
And what about warrants? That sounds like another potential complexity, another way the company can subtly dilute existing shareholders.
Yes, warrants are another often overlooked pitfall. Issuing warrants, which are essentially long-term options giving the holder the right to buy additional shares at a set price in the future, can dilute the value inherent in the ordinary common stock for existing shareholders when those warrants are eventually exercised.
So more shares get created, shrinking your slice of the pie.
Exactly. And even worse, companies sometimes compute their reported per-share earnings without making a proper allowance for the potential dilutive effect of outstanding warrants. This, of course, overstates the true relationship between those earnings and the market value of the company's total capitalization. It's a subtle but significant form of potential future dilution that can eat away at an investor's true ownership stake and future returns.
Wow. So many ways to be misled, even for the most diligent investor. This makes the choice of advisors absolutely critical, but in a world saturated with financial advice, TV, internet, friends, family, who can you truly trust?
Skepticism is paramount here. Graham warns against relying blindly on advice from relatives or friends, noting sagely that much bad advice is given free.
That's certainly true.
When it comes to brokerage houses, while they perform the essential function of executing buying and selling orders for a standard commission, their fundamental business model thrives on frequent transactions. So they can hardly avoid being speculation-minded, consciously or unconsciously.
Their interests aren't always aligned with the long-term investors.
Right. The intelligent investor, Graham insists, must show clearly, by word and deed, that he or she is not interested in anything faintly resembling a stock market tip or short-term trading idea. You need to set the tone of the relationship.
What about professional investment counselors or financial advisors? For those who don't want to manage their own portfolio directly, is that a safer option?
It can be. For those willing to pay a fee, a well-established and well-recommended investment counsel firm, or perhaps the trust department of a bank, can provide professional administration of your investments. However, even then, Graham insists that you, and no one but you, must investigate whether an advisor is trustworthy and charges reasonable fees. Do your due diligence on the advisor, just like you would on a stock.
What kind of questions should you ask?
He suggests asking critical questions, such as, how high an average annual return do you think is feasible on my investments over the long term? Graham advises that any advisor promising returns consistently above, say, 8% to 10% per year is likely being unrealistic and should be viewed with extreme caution. It might imply they are taking undue risks or simply making unrealistic promises to get your business.
So manage expectations and be wary of promises that sound too good to be true. Ultimately, the power lies with the shareholder, even if it feels diffused in large corporations. Graham also talks about the power, or maybe the responsibility, of the shareholder voice, doesn't he?
He does. He believes shareholders needed to actively judge management efficiency and demand proper recognition for their interests as the true owners of the company. He even highlighted how takeovers, though sometimes viewed negatively as hostile or disruptive, have, in a way, rescued the cause of the shareholders historically. By providing a mechanism to replace inefficient or self-serving management, thereby forcing management teams, even those not facing an immediate takeover threat, to act more in the shareholders' interest to avoid becoming a target. This became particularly evident during periods like the 1970s and early 80s, when corporate efficiency in America was perceived to be quite low. This market mechanism, though sometimes seen as aggressive, serves as a crucial check on management that might otherwise ignore shareholder value or pursue their own empire-building agendas over those of the owners.
Okay, here's where it gets really interesting, the absolute core of Graham's philosophy. This brings us to what he considered the central concept of all sound investing, the one idea that underpins everything else we've discussed: the margin of safety. If he had to distill the secret of sound investment into 3 words, that would be it, right?
Absolutely. Margin of safety. He says it explicitly. It is precisely the thread that runs through all of Graham's investment policy and philosophy. It's a concept designed fundamentally to protect you against the inevitable uncertainties, errors in judgment, and just plain bad luck that are part of investing.
So how does he define it? What is the margin of safety in practice?
He defines it simply as a favorable difference between price on the one hand and indicated or appraised value on the other. You figure out what a business is realistically worth based on thorough analysis, and then you insist on buying it for significantly less than that appraisal.
Creating a buffer.
Exactly. That difference, that cushion you build in, is available for absorbing the effect of miscalculations or worse than average luck. It's your buffer against reality not quite matching your optimistic projections, or against things going wrong that you couldn't foresee.
So it's not just about being right in your analysis, it's about being protected even when your analysis turns out to be wrong, or when unforeseen negative events occur. That seems critical. Why do so many investors seem to overlook this seemingly simple fundamental principle?
Because it demands patience, discipline, and often a willingness to be unfashionable, to buy what others are selling or ignoring. It directly challenges the very human urge to chase what's popular, what's exciting, what's expensive. Think of it like applying Blaise Pascal's philosophical wager to investing.
Pascal's wager? How does that fit?
The intelligent investor, like Pascal pondering belief, focuses not just on getting the analysis right, which is hard enough, but also on ensuring against catastrophic loss if your analysis turns out to be wrong. Because let's face it, even the best analyses will be wrong at least some of the time. The probability of making at least one significant mistake at some point in your investing lifetime is virtually 100%.
You can't control being wrong sometimes.
You cannot control that fact. However, you do have control over the consequences of being wrong. And you control those consequences by always insisting on buying with an adequate margin of safety. It's buying a business for significantly less than its conservatively estimated intrinsic value, so you have substantial room for error before you actually lose money.
This sounds like value investing at its absolute core. Finding something priced at, say, 60 cents that's actually worth $1, maybe more.
It is exactly that. Value investing in the Graham tradition means buying a dollar bill for 60 cents or maybe even 40 cents if you can find it and have the conviction to act. And Graham actually states, quite provocatively, the greater the potential for reward in the value portfolio because you're buying so cheap, the less risk there is.
Wait, more potential reward means less risk. That seems counterintuitive to how most people think about risk and reward.
It absolutely is counterintuitive to modern finance theory. It contrasts sharply with traditional risk measures like beta, which essentially just measures how much a stock's price tends to move up or down compared to the overall market. So a high beta stock is often seen as more volatile and thus automatically labeled riskier by that academic measure.
But Graham disagreed.
Vehemently. To Graham, risk isn't volatility. Risk is the chance of suffering a permanent loss of capital. And you mitigate that risk most effectively by buying assets for substantially less than they are worth, by demanding that margin of safety. He uses the powerful real-world example of the Washington Post Company back in 1973.
What was the situation there?
The entire company was selling for a market capitalization of a mere $80 million in the stock market. But its underlying assets, the prestigious Post newspaper, Newsweek magazine, which was profitable then, several valuable TV stations, could have easily been sold, conservatively estimated, for not less than $400 million to any one of probably 10 different buyers.
Wow, so you were essentially buying $400 million worth of prime assets for just $80 million. That's an enormous margin of safety, like buying $1 for 20 cents.
Precisely. Now here's the kicker. If that stock had declined even further, say to a market valuation of $40 million because of market panic, its measured beta would likely have increased, making it appear even riskier by conventional academic measures. Graham found this kind of thinking truly Alice in Wonderland.
Because the cheaper it got, the less risky it actually became from a value perspective.
Exactly. His core point is that you're buying the business, not just the stock ticker. And with an adequate margin of safety, you are protecting your life against the unforeseen, against Mr. Market's wild mood swings, and critically, against your own potential miscalculations or errors in judgment. You're buying tangible value at a discount, not just a fluctuating ticker symbol.
Which brings us, I think, to the ultimate truth about investing that Graham continuously reminded us of, even in the face of constant market noise and uncertainty.
And that is that uncertainty and investing are basically synonyms. They are inseparable. You cannot have one without the other in the real world. No one has ever been given the ability to see the future, to know for sure that any particular time is the absolute best time to buy stocks.
The headlines are always full of fearful facts and unresolved risks, aren't they? There are always reasons to hesitate, to wait for clearer skies.
Always. But Graham concludes, without a saving faith in the future, a belief that, over the long run, progress continues and businesses create value, no one would ever invest at all. To be an investor, you must, at your core, be a believer in a better tomorrow, or at least a tomorrow where well-run businesses continue to thrive. It's an act of quiet, persistent, rational optimism.
What a powerful thought to end on. We've covered a tremendous amount of ground today, unpacking Benjamin Graham's timeless wisdom from the intelligent investor. The core message remains just incredibly relevant now, maybe even more so than when he wrote it decades ago.
It really does. Distinguish true investment from dangerous speculation. That's job one.
Control your emotions in the face of Mr. Market's wild swings. Don't let him dictate your actions.
And always remember that true, sustainable value creation comes from the underlying business, its earnings power, its assets, not from fleeting market sentiment or media hype.
And if you are to be truly intelligent in your investing, you must adopt strategies, whether defensive or enterprising, that foster long-term financial success.
While diligently avoiding the common pitfalls of hype, opaque accounting practices, trying to time the market, and placing blind trust in so-called experts or hot tips, your financial well-being is ultimately your responsibility. No one cares about your money as much as you do.
So as you go about your day, maybe reflect on this. In a world of constant market noise where everyone wants to tell you what to do and what's hot, what would it truly mean for you to consider your portfolio not just as a collection of fluctuating stock prices, but as a diverse group of small private businesses you actually own shares in?
How might that fundamental shift in perspective change your daily decisions, your reactions to scary headlines, and maybe even your peace of mind, especially when Mr. Market comes knocking at your door with his wild, often irrational offers?
Maybe take some time to reflect on your own investment habits. Ask yourself honestly, are you truly acting as an intelligent investor, guided by analysis and value, or more like a speculator, chasing short-term gains, following the herd, or reacting emotionally?
And if you're curious about applying some of these new strategies, perhaps try tracking a dummy portfolio based on Graham's principles on paper first, before committing real money. See how your disciplined decisions play out over time without the emotional pressure of real gains and losses.
It's a great way to learn. Remember, true intelligence in investing, as Graham taught us so profoundly, is ultimately a trait more of the character than of the brain. It's about cultivating patience, discipline, emotional control, and a persistent willingness to learn for yourself, to do the work, and perhaps most importantly, to think independently.
We hope this deep dive has armed you with not just the knowledge, but also the mindset to do just that on your own investing journey.
Don't forget to like, comment, and subscribe to ReadersPair, where two readers bring you one book and endless insights. See you in the next chapter.